Computacenter surged as much as 11% on Thursday after raising its full-year guidance, with the company saying first-half adjusted pre-tax profit would come in at around double last year's figure. That figure is striking until you read the fine print. Last year's H1 comparative was explicitly described as a relatively soft £81.5 million. Doubling a soft baseline produces a large percentage gain without necessarily proving structural growth. The bottleneck in today's announcement is not whether demand is real, it is whether the H1 run rate persists. Computacenter said its committed product order backlog at the end of June was well above the £7.1 billion reported at the end of 2025. A backlog rising while profit doubles sounds unambiguously strong, but the key question is what is inside that backlog: sustained AI project wins or a concentrated wave of hyperscaler orders that already peaked. Non-holders watching the plus 11% opening move face immediate pressure. The AI trade in UK technology names has been under-owned for months, and this looks like a breakout. Holders face the opposite. The stock reached 4,594p intraday, close to its 12-month high of 4,702p, and taking profits at a near ceiling after a soft base pop is exactly what rational holders would do.
Computercenter's trading update named two drivers: surging demand from hyperscaler customers in North America and continued AI-related projects in the UK. Those are not the same business. The hyperscaler orders are large, lumpy, and driven by customers, Microsoft, Amazon, Google, who are racing to deploy AI infrastructure at a pace that produces uneven quarterly ordering patterns. When a hyperscaler front-loads an order, the reseller's revenue jumps. When the deployment window closes, orders normalize. The backlog figure of well above £7.1 billion is a point-in-time measure of committed orders, not a forward guarantee of the margin on those orders once fulfilled. The UK AI project business is structurally different: smaller engagements, higher margin, and driven by enterprise adoption of AI tools that has been building steadily rather than in spikes. The trading update does not separate these two streams, which means the profit guidance raise could be driven primarily by the volatile hyperscaler component. Full-year consensus was $313.7 million. Computacenter now says it expects to come in comfortably ahead. If H1 lands at around $163 million, double last year's $81.5 million, then H2 needs to deliver only around $150 million to beat consensus. But Computacenter's own language flagged the H2 comparative will be harder. Last year's H2 was not described as soft. The H2 sustainability question is the real test, and it is not resolved by today's update.
Computacenter opened up 11% and ended the session up around 6.5%. That fade is not noise. It is the market's own verdict on the base effect question, playing out in real time. Some buyers who entered on the guidance raise were met by sellers who already held the position from lower prices and saw a near 12-month high as the exit point. The stock's 12-month range is 2,092p to 4,702p. At 4,594p, it is already in the top 5% of its annual range. Entering near an annual ceiling after a base effect profit pop carries a specific risk. If H2 delivers only in line with the prior year rather than another uplift, the stock re-rates downward, and the 11% opening gain becomes a temporary top. The counter to that reading exists in the pool and deserves acknowledgement. The committed backlog at end June was stated as well above £7.1 billion, and Computacenter described trading in Q2 as ahead of expectations, building on an excellent first quarter. If both halves of 2026 carry genuine AI project momentum, not just a front-loaded hyperscaler order wave, the full-year figure could beat $313.7 million by a wider margin than today's cautious language implies. That is the path on which today's buyers are right. For holders at any price below £3,500, the position is already significantly profitable. The question is whether to trim into the 11% opening surge or hold for H2 confirmation. For those watching from the sidelines, the entry trigger is H2 data, specifically whether the committed backlog converts to revenue at H1 level margins or shows the fade that hyperscaler order normalization typically produces.
The interim results are expected around September 2026. If H2 margins hold and full-year profit lands materially above $313.7 million, the re-rating is structural, and the current price is the entry. If H2 margins compress as hyperscaler front-loading unwinds, the base effect trap snaps shut, and 4,594p will look like a ceiling, not a floor. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.